Hey, welcome. My name is Kyle, and this is going to be an e-tutorial on how to solve problem E15-11 from the Pearson workbook. So on September 30th, 2020, when the market interest rate is 6%, Jammer Limited issues 8 million of 8% 20-year bonds for 9.8 million. The bonds pay interest on March 31st and September 30th, so twice per year, so that's a semi-annual interest payment. And what we need to do is prepare an amortization table for the first 4 semi-annual interest periods. Follow the format of Panel B in Exhibit 15-7 on page 835 of your textbook. So that's what I have down here. I've already just typed in a template for us. And they use the premium, or they amortize the premium by the effective interest rate method. And requirement 2 is to record the issuance of the bonds of September 30th, the accrual of the interest, and the semi-annual interest payment on March 31st. So that's referring to preparing journal entries. Okay, so before we start this problem, let's just go through a few things about it to make sure we're comfortable with all of the terminology. So we have the market interest rate, that's 6%. It was $8 million. That's the face value of the bond. So remember, the face value is the amount that the bond holder is going to receive at the end of the term of the bond. So how much the borrower, the corporation, is going to be paying to the lender, the bondholder at the end of the term. And the face value never changes. That's going to be how much is going to be received by the bondholder at the end of the period. We have 8%, that's the coupon rate or the contract rate or the stated rate. This also doesn't change. And it's these two together, the face value multiplied by the coupon rate, that dictate the payment that's received by the bondholder. And those don't change. So we have 20-year bonds, so that's reflective of the term of the bond. So since it's 20 years and there's interest paid semi-annually, so twice per year, that's going to equal 40 interest payments in total. And then we have the actual cash received on issuance. So why is the cash received on issuance greater than the face value? Well, remember, there's an inverse relationship between bond prices and market interest rates. When interest rates in the market go down, bond prices go up. Is that what's happening in this problem? Well, let's just read the question to see. The market interest rate is 6%, which is less than 8%. So since this bond was created and issued, the market rate dropped, so market rate decreased. And the bond was issued, it has a face value of 8 million, but issued at a price of 9 million, which means that the bond price went up. So remember, there's always an inverse relationship between interest rates, the market interest rate, and bond prices. Interest rates go down, bond prices are going to go up. That's important for us to remember. So I think I'm going to start this problem actually by just doing the first journal entry, and then we'll get into doing the amortization schedule. So think about first, well, why do corporations issue bonds? What's the point? The point is to raise money. They need cash, so they decided to issue debt, issue a bond in order to raise that funds. So since they issue bonds to raise money, I know that cash for this organization is going to be going up. And the amount that cash is going to increase by is the issue price of the bond. That's 9,849.12. So cash is going up, and bonds are kind of just like giant IOUs. The corporation needs to pay back the bond to the bondholder at the end of the term. They're the borrower. They need to pay back the lender. It's kind of like a loan. So since they need to pay back that, they need to be recognizing a liability on payable. Now, the amount that they need to recognize is the amount they're going to be paying back to the bondholder, and that amount is the face value. That's the amount that's paid back to the bondholder at the end of the term. Now, you'll notice here, these don't match. Obviously, my debits don't equal my credits. My journal entry is incomplete. What I need to do is also recognize what's called a premium on bond payable. Balance my journal entry. Now, we already know that when market interest rates go down, bond prices go up. And since the face value is 8 million, this is exactly what happened in this problem. Face value is 8 million, but the issue price is greater. So this is what's referred to as issuing bonds at a premium. And when that happens, we need to credit this premium on bond payable account. And this is kind of like a companion account to the bond. It increases the carrying amount of the bond. Why? Well, these two together are reflective of the current market value of those bonds. So the corporation recognizes the liability essentially for the current market value of what those bonds are. So those two, the 8 million and the 1.8 million, are reflective of the market value of that bond, and that's the total liability recognized on the balance sheet. So let's start preparing now the amortization schedule. They issued the bond on September 30th, 2020. At that time, the unamortized premium is the premium on bond payable, 1849.82. Which means that the bond's carrying amount, the total liability recognized on the balance sheet, is the 8 million plus what hasn't yet been amortized. So what we're going to see, and hopefully we've done the other tutorials as well, and you've done a little bit of this in class, but this premium on bond payable account gets amortized over the term of the bond, which here is going to be 20 years. Which means that the premium gets reduced so that the bond's carrying amount when the term reaches maturity, so at the maturity date, the bond carrying amount is going to be the amount of cash paid to the bondholders, which is going to be the $8 million. So we need to reduce this premium on bond payable with every interest payment over the life of the bond. So it yet has not been amortized. So that's why it's called the unamortized premium balance. It's going to be amortized. So the very first interest payment is going to be on March 31st, 2020. This interest payment column here, this is referring to, well, how much cash is the bondholder going to receive at that date? And remember, that's dictated by the coupon rate multiplied by the face value and then prorated to the number of months. So in this case, the interest rate always actually is going to be stated annually, but interest payments here are semi-annual, so we need to prorate it to 6 months of the year. So it's going to be 8 million, which is the face value, multiplied by the coupon rate, which is 8%, multiplied by 6 divided by 12, and that's going to equal something, and I'm not capable of that math in my head, so I'm going to do that right in the cell where it needs to go. 8 million percent times 6 divided by 12, 320,000. So that's the cash that the bondholder is going to be received and paid, will be received by the bondholder as of that day. But that's not the interest expense that the corporation is going to reflect on their income statement. The interest expense they're going to reflect is going to be dictated by the market interest rate and the carrying amount of the bond. Remember, they received more cash because there was a premium on the bond. Cash was higher because the interest rates were lower. So since that happened, the interest expense is going to be the 6%, and maybe I'll do this oops. I'll do this in my red pen first. So that's going to be the market rate. That's the interest rate multiplied by the bond carrying amount here, and then multiplied by the number of months, prorated to the number of months, because the market rate is always stated annually. So the bond carrying amount from the prior period was 9.8 million, multiplied by the market rate, multiplied by 6 divided by 12. That's 295,475. So that's the interest expense they're going to recognize on the income statement on March 31st. Now, we're going to see actually in a minute that they need to make an accrual for a portion of that, but for purposes of the schedule, we can leave it at that. So let me just clean this up. Okay. This means that they're actually going to have to, well, obviously now, these don't match, obviously. So what they need to do is they're going to amortize some of the bond premium on this date. And of course, I'm getting a phone call, so excuse me here. Okay, and I'm back. Hopefully that worked. I don't know. I'll find out when I watch this later. But where was I? Let me see. So obviously the interest payment here, the cash that's received by the bondholder, doesn't match the interest expense on the income statement. So what they need to do is amortize some of the premium balance. So currently this is what's on amortized, the 1.8 million. So the amount that's going to be amortized is going to be the interest payment minus the interest expense, so $24,000. Which means now after they do that, the on-amortized amount is going to be lower because they're amortizing some of the premium, and also the carrying amount of the bond is going to be lower because the companion account is also lower. So remember, the on-amortized premium balance is the premium on bond payable, and this is going to have a T account. So if I go premium bond payable, on our original journal entry, it was 1849182. And I know we're going to be doing journal entries in just a minute, but effectively what's happening here is this discount amortization is going to be a debit. And if I could just learn to write like I did in grade 2 and properly space things out, that would be a lot better. Which means that the amount in the premium on bond payable account after we amortize some of the premium is going to be 1824657, which is what we have here. So hopefully that makes sense. It's a little bit messy. My apologies for writing directly on the template. Hopefully you just write in the space next to your template. And in looking at this, I noticed that what we have here in the template, this says discount amortization, it should be premium amortization. Okay. So then what we have, that's the March 31st interest payment. The next one is going to be, of course, September 30th, 2020. The interest payment doesn't change. This is, remember, is the amount of cash that's going to be received by the bondholder, and that's dictated by the face value and the coupon rate. Face value and coupon rate, and those don't change. So the interest payment that's received by the bondholder, or the amount that the amount of cash that the borrower, the corporation, is going to be paying to the lender, that's not going to change. The interest expense, though, is going to be, remember, the carrying amount of the bond here, which is 9824657 multiplied by the market rate, which is 6%, and then prorated to 6 months of the year. So that's 984,657 multiplied by 6% multiplied by 6 months of the year, which is 294. And of course, these don't match the interest payment and interest expense. So what they need to do is amortize some of the bond premium, and the amount that they're going to do is 25,260, which means the unamortized amount is now decreased. So also means the bond carrying amount is decreased. Now it's fairly obvious I didn't plan too far in advance here, because what I'm going to do, just to illustrate this point home again, is I'm going to put this premium on bond payable in a T account. So premium bond payable. The original journal entry we did was a credit for 1849182. What would happen here is, and I'm ignoring any year-end or accrual considerations, is we've amortized some of the premium. So that would be a journal entry of 24,525, and then we did another one of 25,260, which means after debiting this account by those amounts, the unamortized amount, or the premium on bond payable, is going to be 1,799,397. So this is the unamortized amount of the bond premium. Now, we're going to see in this problem, though, while that is correct, what I just went through, the portion of that needs to be accrued into the proper period, and I'll explain why in just a minute. So that's September 30th, 2020. This was the first 4 semi-annual interest payments. So I've done 2. The next one's going to be March 31st, 2021. The interest payment doesn't change. Remember, that's the amount that's going to be paid from the corporation to the bondholder. The interest expense will change. The prior period's bond carrying amount multiplied by the market interest rate, and then prorated to 6 months of the year, because the market interest rate is always stated annually. Which means that they need to amortize some of the bond premium in order to balance out what their journal entry would be and to lower the bond carrying amount. Which means that the unamortized bond premium is decreasing, and additionally, the bond's carrying amount is also being decreased. So what we're going to see after this problem is over, and maybe I'll do it now, is that, sorry, I'm just putting in a formula. As is fairly obvious, I cannot do 2 things at once, so we're going to see here, if I were to copy this down, because hopefully I've set everything up as a formula, is at the end of this bond, in the 20 years time, once that happens, the bond carrying amount is going to decrease to exactly $8 million. And that is how much they're going to be paying back to the bondholder at the end of the term. So $8 million. So there's a little bit of a rounding error here of just $1. I'm not too concerned about that, because accountants have what's referred to as this principle of materiality, and a $1 difference on something, $1 rounding issue on $8 million is less than a fraction of a percent, and it doesn't have a material impact on financial statements. But if that's going to be the 20 years later, so which is going to be on, well, probably September 30th, 2039, 20 years later. Okay, so that's part A, or part 1, done. Part 2 was to record the issuance of the bonds on September 30th, and then, which we've already done, the accrual of the interest on December 31st. So obviously we need to do journal entries whenever an interest payment is made on a bond, but we also need to do any accruals, or otherwise what may be more common terminology for you is adjusting entries at the end of the accounting period to have all expenses incurred in that accounting period reflected in that accounting period. So we have the very first interest payment on March 31st, 2020. Now the assumption here is that this organization prepares financial statements at the calendar year end, so their fiscal year corresponds with the calendar year. So they need to do a journal entry in order to reflect the portion of interest that they incurred from September to December. Remember, this interest expense here of 295,475, that's 6 months worth of interest. However, they incurred 3 months of that as of December. So they need to set up an accrual in order to do that. So if 295,475 is 6 months worth of interest, to prorate that or reduce it to only 3 months, we're going to multiply that by 3 out of the 6 months, and that's going to equal something, and that's the amount of interest expense that they're going to accrue and need to do an adjusting entry for at the end of December. So 147,738. 147,738. But whenever we amortize the premium, we're also doing journal entries for it. And the amount of the journal entry is this premium amortization amount. So this amount that's been amortized here, and remember I was doing this in T accounts, what I did in T accounts would be the full 6 months worth. What we need to do, or prorate the 24,000 to be 3 of that 6 months. So we need to lower the premium on bond payable set up an adjusting entry to lower for 3 months of what's been incurred as of December. So again, it's going to be the same thing. 24,525 multiplied by 3 divided by 6, and that's going to be something. $12,263. Okay. Which means that what they need to do is set up a payable for all of that stuff, right? They're going to pay it, they just haven't paid it yet. And the amount that they need to set up a payable for is going to be the two added together, which is 160,000. So you'll notice, hopefully right away, that 160,000 is exactly half of the interest payment. Divided by 320 equals 50%. And remember, because we did 3 of the 6 months, they've incurred 3 of the 6 months as of December. They need to reflect 50% of the interest payment as of December. And remember, that's going to be the cash payment to the bondholders. So that's the accrual of interest at December 31st, 2020. And now what we need to do is the actual semi-annual payment on March 31st. So, well, what do we have? We know the March 31st payment, and you know what? I'm going to highlight this just so it's easier for us to look at. This is what we were just talking about, this line here. We've already recognized an expense for half of that. We did 147,738 of it. So, and that reflected 3 of the 6 months of interest. So we've already recognized half. Oops, I'm going to just switch my color here. We've already recognized half of this interest. We've also already recognized half of that premium. So what I'm going to do is set up an interest expense. And it's going to be for the other half, the remaining 3 months. So the amount is going to be exactly the same, 147,738. And again, that's going to be 295,475 multiplied by 3 of the 6 months. Additionally, this organization also has already recognized half of the premium. And they did it in December. So they need to recognize the other half, and it's going to be exactly the same amount. And when they recognized it in December, they set up this payable for it. Now, though, now that it's March and we're actually paying it, we need to lower this payable down to 0. Why? Because on March 31st, we're actually making this interest payment. We need to lower that to 0 by debiting it. Now, what's going on here? I have 3 debits and no credits. What am I going to need to do in order to complete this journal entry? Well, what are they actually doing? They're paying the bondholders. They're paying the bondholders in cash, and the amount of cash they pay the bondholders doesn't change. It's going to be $320,000, which is the interest payment in this column. So hopefully, I'm just going to double check that these 3 add up to 320 so that I know I did it all right. And it does, which is a good indication. So we've completely solved this problem. Let me just erase my markup, go back to the top. And apologize to you for the phone call interruption. Hopefully that will be edited out, but no guarantees. And we'll see. So thank you so much for listening. I hope that you found this tutorial helpful. My name is Kyle. Have a great day.